Hey, what is going on, guys? My name is Nick, and for today's video, I've made a master list of the 12 best stocks to buy over here in Canada that trade on the Toronto Stock Exchange, or the TSX. Now, I know a lot of my viewers are Canadian, but if you are from the US, this list has a lot of ticker symbols that do trade on both the TSX and US exchanges, so make sure to stick around for those. Anyways, guys, I really would appreciate a like on this video, as it took tons of time and research to make it, as there are 12 different stocks. And also, if you haven't already, definitely consider subscribing for more investing content coming from my channel very soon here. So with that said, let's get right into this TSX master list. All right, for the first stock of the day, we have none other than Shopify with ticker symbol shop.to, and then it's also in the US as ticker symbol shop. I'm sure this company needs no introduction, having quickly grown to be Canada's #1 largest company today. But for those who aren't aware, Shopify allows you to easily build your own e-commerce website to sell basically anything directly to the consumer, where they offer fulfillment, payment options, analytics, and much more. Shopify also partners with Facebook, Instagram, and TikTok to allow merchants to sell products directly to their followers on the social platforms, which will be a huge growth driver for them over the long term. And the sheer beauty of Shopify's business model just comes from the fact that they generate tons of recurring revenue from their merchant monthly subscriptions that's been growing at a compounded annual growth rate of 46% since 2016. And for this reason, Shopify has always commanded a much higher valuation than most stocks, right now being at a forward PE of 234, while its price to sales is a whopping 55. But sometimes, guys, you need to pay a premium for such an excellent company growing in a very fast industry, and that is why I'm happy holding Shopify in my own personal portfolio. But now let's move on to stock number 2, taking a complete shift in industries, and that would be Brookfield Renewable Partners with ticker symbol BEP.UN.TO. Now, Brookfield is Canada's largest renewable energy business that owns and operates renewable power assets such as hydroelectric, wind, solar, and energy storage facilities, where about half of their revenue comes from hydropower. The company is also very well diversified geographically, with over 59 billion in assets and operating nearly 6,000 power generating facilities across North America, Latin America, Europe, and Asia. Now, over the past year and a bit, there's been a huge push for renewable energy as Joe Biden got elected, boosting Brookfield's stock price like crazy, as well as their FFO to 42 cents per unit, which is a 23% increase from 2020. Right now, they have a forward distribution yield of 3.3%, where the management is targeting a 70% payout ratio. And then Brookfield has been growing their distribution each year for the past 8 years, while the management is targeting a 5 to 9% compounded annual growth rate of that dividend in the future. Now, it should be noted that while Brookfield's dividends are paid out in US dollars, and then they're also called distributions like for REITs, you actually won't have to pay a withholding tax as a Canadian, so it's good to hold this one in a TFSA. All in all, I think it's really important to hold a company like this in your portfolio to take advantage of the inevitable renewable energy transition coming in the future, and I think that Brookfield is positioned very well to capitalize on this opportunity. All right, but now moving on to stock number 3, and that would be Fortis with ticker symbol FTS.TO, and then it's also in the US as FTS. As many of you would know, Fortis is a company I've talked about several times, and I absolutely love this business for many reasons I'm about to explain. So Fortis is a 99% regulated North American utility company that provides the transmission of electricity and natural gas to their customers. And if you weren't already aware, a regulated utility simply means that the utilities own and operate all of their electricity, and they essentially have a monopoly, but prices are regulated by the governing utility commissions. But basically, this makes for an incredibly stable and consistent business model, ensuring growth over time. Meaning that yes, Fortis is an incredible dividend growth company, which is typical for utility companies. Buying into Fortis today would give you a starting yield of 3.8%, and then they have a payout ratio of 75%, which I would not be worried about in the slightest, because this utility income is so recurring and it's very stable. Then management is projecting a dividend compounded annual growth rate of 6% in the future. In fact, just on September 29th, Fortis announced a dividend increase of 6% to $0.535 per share, marking the 48th consecutive year of dividend payments and increases. Overall, this is one of Canada's most reliable dividend payment companies, and they'll probably never miss a dividend payment, which is why I love this company. But moving on to stock number 4 here, we're switching gears completely with Allied Properties REIT with ticker symbol AP-UN.TO. Allied Properties is a $5 billion real estate investment trust, or a REIT, with over 200 properties comprising about 14 million square feet across Canada. Now, this REIT focuses on creating urban workspaces for professionals in the tech, advertising, media, and information fields, where all of their properties are super modern with tons of natural light and fresh air. And what's quite incredible about Allied Properties is that they've been growing their asset portfolio very quickly at a compounded annual growth rate of over 26% since their IPO back in 2002. Not only that, guys, but it's hard to find a REIT that consistently increases their FFO per share, or their funds from operations per share, allowing them to increase their distribution payments over time, but Allied Properties is one of them. Ever since 2004, they've been increasing their distribution payments, but they did hold it constant from 2008 to 2012 because of the financial crisis. But over time, they've had an average growth rate of about 3 to 4% for their dividend every year, which isn't that great, but it is still growing. And buying into this REIT right now would give you a starting yield of 4.1% on the distributions, and then they have an AFFO distribution payout ratio of 80%, meaning that 80% of their income basically goes to the shareholders in terms of distributions. And because REITs have these very long contracts in place, this isn't a concern whatsoever, because 80% is pretty average for a REIT. Finally, since 2003, the total shareholder returns have been 14.9% per year, which is great to see, and I think this REIT is going to continue growing very quickly. All right, getting into stock number 5, we have one of the big 5, and that would be TD Bank with ticker symbol TD.TO, or TD in the US. TD is, of course, Canada's second largest bank, right behind RBC, worth about $150 billion. And TD operates all across North America in 3 key business lines, which are Canadian retail banking, US retail banking, and wholesale banking. In fact, TD is the one Canadian bank with the largest and growing presence in the US, which is one of the reasons why it has seen so much growth over the past decade and longer. But the main reason why you should love TD Bank so much is for their dividend and its growth. Right now, they're offering a starting yield of 3.7%, but if you take a look at their payout ratio, it is incredibly low at 37% right now. So this tells me that TD management will be able to easily increase this dividend going into the future, so stay tuned for that. And then TD has a dividend payment history of 164 years. Yes, you heard that correctly, but then 12 years of increases because it was paused in 2008 for the financial crisis, and then again in 2020 because regulators forced them to pause the dividends. But over time, they have had a growth rate of 11% on average, so that is really good to see. Overall, TD is one of Canada's largest yet fastest growing banks that continues to grow its dividend at a very fast rate over time, and this is the reason why I love this bank so much. All right, now jumping into stock number 6, we're back to technology with a company called Constellation Software with ticker symbol CSU.TO. So Constellation Software is a $40 billion company that acquires, manages, and builds market-leading software businesses for both the public and private sectors. So basically, what you need to know is that Constellation Software grows via acquisitions, which is an inorganic growth business model. Many investors actually prefer organic growth because it shows that the company has a unique product or service and that it's in high demand, and because basically any company can acquire another company just to fuel their growth. But as you can see from their stock price, Constellation Software has done an excellent job in acquiring and merging these smaller tech companies and then building them into bigger brands, so obviously they've done a very good job and continue to do so. I would say alongside Shopify, Constellation Software is one of the fastest growing companies in all of Canada, having revenue growth of 35% in their latest quarter. And it should be noted that they also pay a small dividend, which is a payout ratio of 24% with a yield of 0.24% right now, so it is pretty insignificant, but I should mention it. Despite this business focusing on inorganic growth via acquisitions, it is still a really great business and they have done extremely well over time, so I would definitely check it out. All right, coming in with stock number 7 at the halfway point here, we have to start moving into some oil stocks, and that would be Suncor Energy with ticker symbol SU.TO. Now, Suncor is a very large position in my personal portfolio, being Canada's largest integrated oil and gas company, meaning that their operations span from bitumen extraction all the way through to the Petro-Canada pump stations. In fact, Suncor owns over 1,500 Petro-Canada pump stations across the country, which gives the company a solid moat when it comes to fuel sales. And although electric vehicles are becoming becoming more and more popular, there is still insane demand for oil, and there will continue to be for several years. For instance, just take a look at oil prices today. They're sitting around $75 per barrel because of current demand, and I can guarantee you Suncor is making a killing off this. Suncor also pays a dividend yielding 3.2% right now with a payout ratio of 84%, but as they regain their profitability from the pandemic losses, this payout ratio will go down. Unfortunately, Suncor did have to cut their dividend in 2020 because of the pandemic, and they haven't increased it since, so this is definitely on the horizon once they've paid down some debt. Overall though, I think Suncor is a very undervalued asset right now because of the uncertainty about oil, but also because of their dividend cut back in 2020, but I think that current oil prices are going to continue allowing them to generate tons of cash. Alright, now moving along to stock number 8 here. Today we have Manulife Financial with ticker symbol MFC.TO. Manulife is the largest insurance provider in Canada and also offers financial services such as banking, investments, and more. Now, if you weren't already aware, insurance companies make money in two different ways. Firstly, through selling insurance packages and getting those premiums, and then secondly, by investing that premium income to higher yielding investments, which is how they generate the majority of their income. Now, as we can see from their stock performance, Manulife had a rough hit back in 2008 where their reputation got tarnished as they did cut their dividend in half, but ever since then the company has been really stable and has been growing their dividend back up. So right now they have a forward dividend yield of 4.6% and then a dividend payout ratio of only 31%. So this signals to me that they probably will be increasing their dividend very soon. I personally have Manulife as my work benefits provider, and through using all of their services in their mobile apps, I really like it and I find them straightforward and easy to use. And for investors, I think that this stock is offering a compelling dividend with a very low payout ratio, so this would be a solid company for anyone's portfolio. Alright, but now it's time for stock number 9, and that would be Canadian National Railway with ticker symbol CNR.TO. You all know that I absolutely love CNR, and it probably has one of the biggest moats in the entire stock market. Just think about the difficulty in trying to compete with CNR unless you're already an established competitor like Canadian Pacific Railway. It's basically impossible to create the vast array of railway tracks and trains this company already owns. And as Warren Buffett always says, you want to find a company with a durable competitive advantage or a moat, which CNR definitely does, and this will allow them to continue growing over time. For this reason, CNR has done incredibly well in terms of stock price appreciation over the years, basically being a growth stock in my own opinion. But the company also pays a small dividend that they've consistently been growing too, so their forward yield is 1.6%. with a payout ratio of 42%, and they have been growing this dividend since 1996, or 25 years, very quickly. Overall, I think CNR is a solid investment that could be held in anyone's portfolio, and it has an incredibly large moat and probably won't be going anywhere anytime soon. Alright, up with stock number 10 right now, we have to talk about Enbridge with ticker symbol ENB.TO. Enbridge is the largest energy company in Canada, but as opposed to Suncor, Enbridge focuses on transporting fluids rather than producing them. So they create and operate liquids and natural gas pipelines all across North America, where they move about 25% of the crude oil produced in the continent, and then 20% of the natural gas consumed in the US. Enbridge has a very resilient business model since their customers who need to transport oil or gas, like Suncor for example, they'll sign a contract to pay Enbridge based on the volume of fuel they ship through their pipelines, which makes it a stable recurring revenue business model. And needless to say, Enbridge has done incredibly well over history with a 25-year total shareholder annual return of 15%, which beats out the S&P 500. Not only that, but I think Enbridge is the best Canadian dividend stock in terms of yield, because right now you can buy into this stock with a 6.6% starting yield. Now, if we're just looking at EPS, Enbridge does have a payout ratio above 100%, but earnings aren't actually the amount of money they can actually distribute to the shareholders. Rather, Enbridge management calculates DCF, which is distributable cash flow, and this ends up being a lot higher than EPS. So based on the low end of DCF range for 2021 that management predicts, Enbridge has a payout ratio of only 71% right now. In terms of their dividend history too, they have 26 years of consistent dividend payments and increases, which is since 1995. And on average it has been about 10% per year. Overall, Enbridge is a company that I've never personally owned, but I will be looking into it a little bit closer because of this crazy starting yield, and they do have a really great track record of shareholder returns. Alright, now coming in with the second last stock, stock number 11 here, we have TELUS, and that has ticker symbol T.TO. TELUS is one of Canada's largest telecom and internet companies that in my opinion offers the best services and is very innovative. TELUS offers mobility, home phone, internet, online healthcare, and home home security among other services, and now also offers 5G network for Canadians. I personally use TELUS for my home internet, and anytime I've had an issue, which has been very infrequent, TELUS is right on top of it and they're very helpful. But for investors, the best part about TELUS is a solid dividend track record. Right now, buying into TELUS, you'd get a forward dividend yield of 4.5%, and then management is targeting a payout ratio of 60 to 75% based on free cash flow, so we can't calculate the payout ratio based on EPS. Now, they do only have a dividend growth history of about 10 years, but they have been growing that dividend very quickly over that time, targeting about 7 to 10% growth through 2022. Overall, I think that TELUS is a solid blue chip dividend company that you can buy over here in Canada, and they will be poised for growth with 5G in the future. And for the last stock of the master list, I thought I'd share one of my own personal investments that is a little bit more speculative, but has tons of growth, and this company is called Greenlane Renewables with ticker symbol GRN.TO. Now, Greenlane is a small cap stock of only $200 million market cap that designs and produces biogas upgrading systems to decarbonize the transportation and natural gas grids. Greenlane is a pure play in the growing renewable natural gas market, or the RNG space, which is the same as natural gas from a pipeline, but it's captured from landfills, dairy farms, and other natural sources that would have contributed to global emissions anyways. This is a company that's seen consistent 100% or more year-over-year revenue growth, while also carrying zero debt on the balance sheet, making this a very attractive investment for long-term investors. Not to mention too, they have a cash balance of $36.5 million right now, which provides a solid cushion to fund their future operations. And since their IPO back in 2019, the stock price has done very well, but they are trading at a 50% discount compared to earlier this year, as the entire renewables sector has been selling off. But personally, I've just been averaging down here as I see a lot of opportunity here in this stock and the renewable sector in general. So there you have it. That is my TSX master list of the 12 best stocks to buy over here in Canada. Leave me a comment down below what you thought, and if you do own any of these companies, I would love to hear it. Or if you thought I should have added some different companies instead, or mentioned some other names, definitely let me know as well. But anyways, if you did enjoy this video, make sure to drop a like for all the research that went into it, and then if you haven't already, definitely consider subscribing for more future investing content just like this, and I will see you guys in the next one.